There is a particular kind of unease that most people cannot quite name. It is not panic. It is not the fear that comes from a phone call or letter with bad news. It is quieter than that. It is the feeling you get when you log into your bank account and notice, for just a moment, that you are checking something you once never thought to check. Whether the money is still there, whether the institution is still there, whether the thing you spent a lifetime building inside that system is as solid as you were told it would be. Many people felt that feeling in March of 2023. Silicon Valley Bank, a federally regulated American institution with more than $200 billion in assets, ceased to exist in less than 48 hours. On a Thursday, customers began withdrawing funds. By Friday morning, regulators had taken control. By Monday, it was gone. Signature Bank followed within days. First Republic Bank collapsed weeks later. 3 large American banks, all within the span of a few weeks. Most people watched the news, felt something they could not easily name, and then went back to their lives. The deposits of large clients were eventually protected. The immediate crisis passed. The headlines moved on. But something did not move on. Something quiet remained. If you are over 50, if you have worked for decades, if you have built some savings and put them somewhere you trusted, that somewhere was almost certainly a bank, or a credit union, or a money market account, or a CD, some variation of the same basic idea. Give your money to an institution, trust that it will be there when you need it, and get on with your life. That trust was not blind. It was taught. It was reinforced by decades of experience. It was backed, we were told, by the full faith and credit of the federal government. And for a long time, for most of our lives, it held. So when 3 banks collapsed in a matter of weeks, the feeling that arrived for many people was not exactly fear. It was something closer to a quiet question, a recalibration. If that can happen, what else can happen? If those institutions, federally regulated, publicly audited, insured, could vanish in a weekend, what does that say about the system those institutions are part of? That is the question we are going to explore today. Not with alarm, not with conspiracy, but slowly, carefully, and with the kind of honesty that the topic deserves. Because the unease you may have felt watching those bank failures unfold was not irrational. It was not the product of anxiety or misunderstanding. It was information. And like all information, it becomes useful only when you understand what it is actually telling you. This video is not going to tell you that banks are going to collapse. It is not going to tell you that your money is in danger. It is going to do something more useful than that. It is going to explain why the feeling exists, where it comes from, and what it actually means for someone who has spent a lifetime trying to be responsible with money. Because the truth is not simple. The banking system is not broken. But it is also not quite what most people were told it was. And understanding the difference between those two things is, perhaps, one of the more important things a person can do in the second half of life. To understand where we are, you have to understand where we came from. And that story begins not in 2023 or 2008, but almost a century ago. In the years following the First World War, American banks were everywhere. There were tens of thousands of them, small, local, often loosely managed, lightly regulated. They made loans on handshakes, took deposits without asking many questions, and operated in a world where banking regulation was a patchwork of state laws rather than a coherent national system. Then the Great Depression arrived. Between 1930 and 1933, roughly 9,000 banks failed. 9,000. Families who had saved their entire lives watched their deposits disappear because the institution holding their money no longer existed. There were no protections. There was no compensation. The money was simply gone. That experience shaped a generation's relationship with money in ways that lasted for decades. It is why many older Americans kept cash hidden in their homes long after the danger had passed. It is why the word bank carried something like reverence and something like suspicion at the same time. Trust had been broken, and even when it was repaired, the memory of the break remained. Congress responded. In 1933, as part of the Banking Act, the Federal Deposit Insurance Corporation was created. The idea was simple and powerful. When you deposited money in a member bank, the federal government would guarantee that money up to a certain amount. If the bank failed, you would be made whole. The insurance was funded by fees the banks themselves paid. It was not charity, it was a structural safety net, built into the system by law. It worked. Bank failures, which had been catastrophic and routine before the FDIC, became rare. The insurance changed something fundamental about what it meant to put money in a bank. It meant that the individual depositor no longer had to judge whether their particular bank was well managed. The federal backstop existed regardless. For 40 years, the system held remarkably well. Americans deposited their money, banks lent it out, the economy grew, and the implicit contract seemed solid. Work, save, trust the bank, retire. But systems are not static. And the banking system changed, gradually, structurally, and mostly without announcement. The first sign of serious strain came in the 1980s. The savings and loan crisis, sometimes called the S&L crisis, was the largest banking collapse since the Depression. Savings and loan associations, which specialized in home mortgages, had been deregulated in the early 1980s and were suddenly allowed to make riskier investments. Many of them did. When the investments failed, the institutions failed with them. By the early 1990s, more than 1,000 savings and loan institutions had collapsed, at a cost to taxpayers of more than $100 billion. It was a significant rupture. It showed that deregulation, combined with federal deposit insurance, could create a dangerous incentive. Institutions could take larger risks than they could truly afford, knowing that if they failed, the government would be forced to cover the depositors. The economists called it moral hazard. Most ordinary people simply called it unfair. Then came 1999. The Gramm-Leach-Bliley Act repealed the Glass-Steagall Act, a law that had separated commercial banking, the business of taking deposits and making loans, from investment banking, the business of underwriting securities and making speculative trades. Glass-Steagall had been put in place after the Depression specifically to prevent banks from mixing the cautious, essential business of deposit taking with the riskier world of financial markets. When that wall came down, banks grew larger, more complex, and more deeply entangled with the financial markets. They were no longer just institutions that held deposits and made loans. They were financial conglomerates, offering mortgages, selling insurance, trading derivatives, underwriting stocks, and competing with Wall Street investment firms. Most people did not notice this change. Why would they? Their local branch still existed. The ATM still worked. The interest rate on their savings account was still low, but the money was still there. The changes were happening at the level of corporate structure and regulatory philosophy, not at the teller window. But the changes mattered, and they became visible in 2008. The financial crisis of 2008 was not simply a recession. It was a near collapse of the global financial system, triggered by the failure of mortgage-backed securities, complex financial instruments that had been built on the assumption that American housing prices would never fall significantly and that had been sold throughout the global banking system as if they were safe. When housing prices fell, those instruments failed, and the banks holding them teetered. Lehman Brothers, one of the oldest investment banks in the United States, filed for bankruptcy in September 2008. It was the largest bankruptcy in American history. Other institutions were bailed out by the federal government. The government took ownership stakes in banks, insurance companies, and automobile manufacturers. Hundreds of billions of dollars in public money were deployed to prevent a total collapse. For many people, 2008 was the first time they truly grasped that the financial system was not a neutral, stable backdrop to life. It was a human construction, vast, interconnected, and capable of failing in ways that affected everyone, whether or not they had ever made a risky financial decision in their lives. And then came the consolidation. In the decades following 2008, The trend that had begun in the 1980s and accelerated through the 1990s reached its logical conclusion. The number of banks in the United States declined dramatically. Where there had once been tens of thousands of small community banks and regional institutions, there were now a much smaller number of enormous national banks. The top 5 institutions now hold a disproportionate share of all deposits in the country. This consolidation was not necessarily intended to harm ordinary depositors. It was the result of market forces, regulatory requirements, and the economics of scale. Larger banks are cheaper to run per dollar of assets. They can absorb losses more easily. They have more sophisticated technology and more lawyers. But they are also harder to understand, harder to monitor, and, as 2023 demonstrated, still capable of failing in ways that are both sudden and surprising. Silicon Valley Bank did not fail because it was reckless in the way that mortgage lenders were reckless in 2008. It failed because it had grown very fast, gathered a very large amount of deposits from a concentrated group of technology companies, invested those deposits in long-term government bonds when interest rates were very low, and then watched the value of those bonds fall as interest rates rose rapidly. When depositors became nervous and began withdrawing, and modern banking technology meant they could withdraw billions of dollars in hours, not days, the bank could not meet the demand. The speed of the collapse shocked even experienced financial observers. A bank run that once took days or weeks could now happen in hours, because anyone with a smartphone and an internet connection could move their money before breakfast. The system had changed, the risks had changed, and most ordinary people had no idea. When people talk about bank failures, they tend to talk about the numbers. The billions of dollars in uninsured deposits. The percentage of GDP. The cost to the Federal Deposit Insurance Corporation. These numbers are real, and they matter. But they do not capture what financial fear actually costs ordinary people. That cost is harder to measure and rarely discussed. Think about a person who is 68 years old. She retired 3 years ago. She has modest savings, not a fortune, but enough to supplement her Social Security and give her some independence. She has kept her money in the same bank for 30 years. She has a checking account, a savings account, and 2 certificates of deposit that she rolled over when they matured, as she always did, because the process was automatic and the institution was familiar and she had never had a reason to think too carefully about it. In March 2023, she saw the news about Silicon Valley Bank. She did not have an account there. She had never heard of it before. But she watched the footage of depositors trying to access their money, heard the word, uninsured, and felt something she had not expected to feel. She felt uncertain. Not panicked, not convinced that her bank was going to fail. Just uncertain, just aware, perhaps for the first time in a concrete way, that there were things she did not know about the system holding her money. She called her bank. She waited on hold for 20 minutes and then spoke to someone who read her a script about FDIC insurance. She went online and tried to understand the coverage limits. She discovered that the limit is $250,000 per depositor per institution per ownership category, a phrase that contains qualifications and exceptions that she did not fully understand. She went to sleep that night with a vague anxiety she could not entirely shake. Not because anything had happened. Not because her bank was in any danger. But because she had discovered that the confidence she had felt for 30 years was partly based on information she had never actually checked. That experience, that quiet recalibration, is not nothing. It takes energy. It takes time. It takes the kind of mental and emotional attention that was supposed to have been resolved by the act of saving. The whole point of putting money in a bank was that you did not have to think about it every day. And now, for many people, that assumption has become slightly less automatic. There is another version of this experience. Someone who has $400,000 in savings. A combination of a 401k rollover, proceeds from a house sale, and 30 years of careful accumulation. Who discovers, in the midst of researching FDIC coverage, that the $250,000 limit means that $150,000 of their money may not be covered by federal insurance in the event of a bank failure. This is not a hypothetical anxiety. It is a real structural fact. Most people are not taught, in any systematic way, how the FDIC works. They are told, in broad terms, that their deposits are insured. They are not told that the insurance has limits, that those limits apply per institution and per ownership category, and that large deposits in a single bank may not be fully protected. This is not a criticism of the FDIC, which is a genuine and valuable institution. It is an observation about the gap between what people are told and what they actually need to know. And that gap has costs. It costs people sleep. It costs them clarity. It costs them the particular peace of mind that was supposed to be one of the rewards of a life spent being careful with money. For people in retirement, financial uncertainty has a weight that it does not have at 30 or 40. At 30, if something goes wrong, you have time. You can go back to work, rebuild, adjust. At 68, that option is more constrained. The stakes of financial loss are higher, not only financially but emotionally, because the savings represent not just money but the distilled labor of an entire working life. When the system that holds those savings seems less stable, it is not just an intellectual inconvenience. It is a kind of existential discomfort. A reminder that the security you worked so hard to build rests, ultimately, on institutions you did not design, do not control, and cannot fully understand. That is not a comfortable feeling. And it is worth taking seriously. There is a deeper question underneath all of this. Not about SVB or FDIC limits or interest rates. A more fundamental question about what it means to trust an institution with the product of your life's work. When you deposit money in a bank, you are doing something that would have seemed remarkable to someone living 300 years ago. You are handing your resources to strangers. Strangers you will never meet, employed by an organization you cannot see inside, making decisions you cannot observe, based on calculations you cannot audit, in a system governed by regulations you have never read. And you are trusting that when you need that money, it will be there. This is not a criticism. It is an observation about the nature of modern finance. Trust in banks is not natural or inevitable. It is constructed, built up over time through law, experience, repeated positive outcomes, and the quiet reinforcement of millions of people going to the ATM and finding their money is still there. That construction was carefully designed. The FDIC, the regulatory framework, the requirement for banks to hold certain levels of capital, the regular audits and stress tests. These are not bureaucratic formalities. They are the mechanisms through which institutional trust is manufactured and maintained. They work imperfectly, but they work. The question is not whether the system works. It is whether it works in the way that ordinary people assume it does. And here is where the story of the last 40 years becomes important. When the banking system was composed of thousands of smaller, simpler institutions, the failure of any one of them was a local tragedy rather than a systemic crisis. A community bank that failed hurt its depositors and shareholders. It did not, in most cases, threaten the entire financial system. The FDIC could step in, cover the insured deposits, find a buyer for the assets, and the system continued. But as banks grew larger and more interconnected, the calculus changed. A bank with $1 trillion in assets is not just a large version of a bank with $1 billion in assets. It is something qualitatively different. Its failure would reverberate through every other institution that holds its bonds, its stock, its derivatives, its loans. Its failure would affect pension funds, insurance companies, money market funds, foreign banks. This is what "too big to fail" actually means. It does not mean those institutions are well managed. It does not mean they are safer than smaller banks. It means that the consequences of their failure are so severe that governments feel they have no choice but to intervene. It means that the market discipline that is supposed to punish bad management and reward prudence cannot fully operate, because allowing it to operate would cause damage that no government is willing to accept. This creates a strange situation. The institutions that are most central to the financial system, The largest banks, the ones that hold the most deposits, the ones that most people depend on, are also the institutions that are, in a sense, exempt from the ultimate consequence of failure. They are protected not because they are safe, but because they are too important to be allowed to be unsafe in public. And the smaller institutions, the community banks, the credit unions, the regional savings banks that serve many ordinary depositors, are not exempt from failure, but they are also not as deeply embedded in the global financial system. They can fail, and they do fail, without causing the same systemic cascade. The 2023 failures revealed something else as well. Modern technology has fundamentally changed the speed at which a bank can fail. In the era before smartphones and online banking, a bank run required people to physically go to the bank, stand in line, and withdraw cash. That process took time in which regulators could intervene, reassuring statements could be made, and the panic could sometimes be contained. In March 2023, depositors at Silicon Valley Bank withdrew more than $40 billion in a single day. Not by standing in lines, but by tapping screens. Social media amplified the panic in hours. The traditional tools for managing bank runs, weekend regulatory action, reassuring press releases, quiet behind-the-scenes interventions, were simply too slow for the new environment. This is not merely a technical detail. It represents a structural change in the vulnerability of financial institutions. And it has not yet been fully addressed. There is something else worth naming here. The promise of banking safety was built on an implicit social contract: work, save, deposit, trust. The institutions that hold your deposits will be managed prudently. Regulators will watch over them. And if something goes wrong, there are protections. That contract was never a guarantee of perfect safety. Contracts rarely are. But for most of the post-war period, it was close enough to a guarantee that most people never had to think carefully about the gap between the promise and the reality. That gap has widened, not to the point of catastrophe, not to the point where the system is broken, but enough that the quiet confidence many people once carried about their financial institutions has become something slightly more complicated. Something that requires a little more attention, a little more awareness, and a little more willingness to ask questions that were once unnecessary. That is not a tragedy, but it is a change. And changes that happen to the systems that hold your life savings deserve to be understood clearly. So where does this leave us? Not with panic, not with the conclusion that banks are dangerous or that the financial system is on the verge of collapse. The system has survived worse than 2023. It survived the Depression. It survived the S&L crisis. It survived 2008. It continues, imperfectly, to function. But it leaves us with a kind of invitation. An invitation to understand the system we depend on a little more clearly than we perhaps did before. The FDIC limit of $250,000 per depositor per institution is not a trivial detail. If you have more than that amount in savings, and many people who have saved carefully over a long career do, understanding how the coverage works is not paranoia. It is basic financial literacy. And the coverage is more flexible than many people realize. Accounts held in different ownership categories, individual, joint, retirement, may be separately insured, which can effectively raise the total coverage for a household with multiple account types. But understanding those rules requires actually reading them, or speaking with someone who has. Spreading savings across more than one institution, when amounts are large enough to raise questions about coverage, is not a sign of distrust. It is a reasonable, practical response to a real structural limit. People do not drive without seatbelts because they believe they are going to crash. They wear seatbelts because they understand that the road is not entirely within their control. None of this requires sophisticated financial knowledge. It requires the same kind of informed caution that you would apply to any important decision, understanding the terms, asking the questions, not assuming that the general impression matches the specific reality. And then there is the emotional part of this. The part that is harder to address with information. Many people who are retired or approaching retirement carry something that might be called financial vigilance fatigue. They have watched recessions, crises, scares, corrections, and disruptions over decades. They have adjusted and readjusted. They have worried and waited and in most cases found that the worst fears did not materialize. And now they are tired. They want, reasonably, to feel that they have done enough. That they can stop calculating and simply live. The 2023 bank failures disturbed that rest. They reminded people that the system requires ongoing attention, even after the years of active saving are over. That the work of financial security does not end on retirement day. That there are still questions worth asking, limits worth knowing, and choices worth making thoughtfully. That is a legitimate burden. It is not the burden that was advertised, but it is the one that exists. What every previous generation that has lived through financial disruption has learned, from the Depression generation that kept cash in mattresses, to the savings and loan generation that watched their thrift institutions disappear, to the 2008 generation that watched their retirement accounts lose 30 or 40% of their value, is that the relationship between savings and security is always more conditional than it appears in peaceful times. The people who navigated those periods most successfully were not the ones who panicked, or the ones who withdrew entirely from financial institutions, or the ones who stopped trusting anything. They were the ones who understood the actual nature of the system they were operating in, its genuine strengths, its real limits, and the places where prudent caution was warranted. That understanding is worth having, not because it eliminates risk, nothing eliminates risk, but because it transforms fear into knowledge. And knowledge, unlike fear, is something you can actually do something with. The banks are not going away. The deposit insurance system, however imperfect, continues to function. The regulatory apparatus, however slow to adapt, is still watching. The institutions themselves, however large and complex and occasionally fragile, are still holding the money of millions of people who are counting on them. But they are not infallible. They never were. And the quiet feeling that arrived during those weeks in March 2023, that feeling of the ground being slightly less solid than it had seemed, was not a mistake. It was an accurate perception of something that had always been true but had been easy to forget. Perhaps the work, at this point in life, is not to recover the innocent certainty of before. That certainty was never entirely earned. Perhaps the work is something quieter and more honest. To understand the system as it actually is. To take the steps that prudence suggests. And then to find, within those steps, the particular kind of peace that comes not from pretending that everything is safe, but from knowing that you have looked clearly at what is real, and made the most sensible choices you can. That is not the peace of certainty, but it is a peace that can be trusted, because it is built on something true.